Investors' fears came to fruition last week as the 2-year and 10-year yield curve inverted for the first time since 2007. In this week's video, we're going to cover what a yield curve inversion really is and also a little bit of history on it, as well as recapping another volatile week from the markets.
The S&P 500 was down almost 1% last week, while the Dow Jones and the Russell 2000 were down over 1%, and the NASDAQ was down about 0.75%. And earlier this year, we saw all four of these U.S. indexes up almost or over 20%, and now the Russell 2000 is barely up double digits for the year. Foreign and emerging markets were both down over 1% this week. While foreign markets are still up 8% for the year, emerging markets are only up 2% this year, which is a far cry off from the double digits they were up at the end of the second quarter. You've probably seen story after story over the past week about the yield curve inverting, so I wanted to take a little bit of time to talk about that today. Last week, the 2-year Treasury note and the 10-year Treasury bond inverted for the first time since 2007. And this means that you can actually get more from a 2-year note than you would on a 10-year bond. And the reason this is such a big deal is because this yield curve inversion has correctly predicted the past 7 recessions. Now, we previously on these videos talked about the 3-month and the 10-year inverting, which is first off a cause for concern, but when the 2-year and the 10-year invert, that's more of a big deal. So now it's important to note that since 1956, the past recessions have started on average 15 months after a yield curve inverts. So today, I wanted to take a little bit of time to talk about what's happened in the markets right after a yield curve inversion, but before the recession actually hits. Next, I want to look at 3 separate charts. First chart we're going to look at here is over a few different time frames, being 3 months, 6 months, 1 year, 2, and then 3 years. What's the S&P 500's average return been after the yield curve is inverted? So if you're looking at this chart, you can see that 3 months after the yield curve inverts, the S&P 500's been up, on average, 2.5% over these past 5 times. 6 months after the inversion, just about 5%. A year, 13.5%. 2 years after the yield curve inverts, about 14.73% return on the S&P 500. And lastly, 3 years after their yield curve inverts, the S&P 500's been up, on average, 16.41%. On the next chart here, we wanted to take a look at how many times these scenarios, the S&P 500 has been positive after the yield curve inverts. So 3 months after the yield curve is inverted, the S&P 500 has been positive 3 out of the past 5 times. Now the S&P 500 has also been positive 4 out of the past 5 times this has happened, 6 months, 2 years, and 3 years after the inversion. But what's most important to note is 1 year after a yield curve inversion, the S&P 500 has actually been positive 5 out of the past 5 times that this has occurred. The fourth and final chart I wanted to talk about today is over the past 5 times the yield curve is inverted, which was 1978, 1980, 1988, 1998, and most recently 2006. How many months did it take for the S&P 500 to reach its peak, and how far away is it in a percentage basis from when that inversion happened? So first off, in 1978, you can see it only took 0.8 months for the S&P 500 to reach its peak, and the S&P only went up 2.2% from when that yield curve inverted. But if you go the whole way down to the most recent, in 2006, it took over 20 months for the S&P 500 to hit its peak after the inversion, and that was over 22% away from the point where the S&P 500 was when the yield curve actually inverted. So that's still a 22% gain in the S&P 500 when the last yield curve inverted to whenever the S&P 500 hit its peak. Now, I wanted to talk about the averages, and on average, it took over 13 months for the S&P 500 to reach its peak, which means when the yield curve inverted, it still took over a year for the S&P 500 to hit that top level. On a percentage basis, that's about 22% away, which is the same number that you'd see here on the chart as what happened in 2006, which means the S&P 500 actually continued to rise about 22% from the time that yield curve inverted. So obviously it's not good news, as the yield curve inversion on the 2-year and the 10-year the past 7 times have triggered a recession. But if you're looking for any positive out of this, it's that over the past 5 times, the numbers don't look so bad.
Last week on Tuesday, President Trump announced that he was going to be delaying the increase on tariffs to Chinese goods that were slated to go into effect on September 1st back to December 15th. He also stated that he was going to work with Huawei to start lifting some of the bans that were put in place. So the initial reaction was great from the market, but we're going to have to wait and see if this can actually help trade negotiations in the long run. One of the news stories that was buried from last week was that we now officially have our first negative interest rate mortgage. It was issued by a bank in Denmark at a negative 0.5% interest rate, which means that you could take out a mortgage and the bank will pay you 0.5% for doing so. Now this is truly historic, and it does show you the state of interest rates globally. Now, we're far away from that here in the United States, but with all of the talks of dropping rates coming in the near future, this could be something that we need to keep our eye on.
All eyes will be on Jackson Hole this week as the central bankers are meeting and the Fed is expected to make an announcement about interest rates moving forward and the state of the economy.
Thanks for watching, and if you're on Facebook, please like and share our video, and if you're on YouTube, please like and subscribe to our channel.